Every earnings season follows the same familiar pattern. Headlines come out saying companies beat expectations. Analysts talk about strong performance. CEOs sound confident on calls. And on the surface, it feels like business is doing just fine. But if you look a little closer, something doesn't quite add up. Because despite all these strong earnings, there's a growing sense that the numbers don't fully reflect what's actually happening inside companies. And that's why more people are starting to question whether strong earnings really mean what they used to. To understand this, you have to look at how earnings are being generated today. Traditionally, strong earnings meant one thing: real growth. Companies were selling more products, expanding into new markets, attracting more customers, and building momentum. Revenue was rising because the business itself was growing. But today, that link between earnings and true growth is becoming weaker. A company can report strong earnings without actually growing in a meaningful way, and that's where things start to get misleading. One of the biggest reasons for this is cost control. Over the past couple of years, companies across the US have become extremely focused on cutting costs. They've reduced hiring, streamlined operations, delayed projects, and in many cases, quietly scaled back ambitions. When you cut costs, profits can go up, even if revenue stays flat. So you end up with a situation where earnings look strong, but the underlying business hasn't really expanded. It's just become more efficient. On paper, that's positive. But it tells a very different story than traditional growth. Another factor is pricing. Many companies have raised prices over the past few years, partly due to inflation and partly to protect their margins. And for a while, consumers absorbed those increases. That means companies were able to generate higher revenue without necessarily increasing volume. In other words, they weren't selling more, they were just charging more. Again, that can boost earnings, but it doesn't always signal stronger demand. In fact, in some cases, demand may actually be softening, even as revenue holds up, and that creates a disconnect. The numbers say one thing, but the reality underneath might be very different. There's also the role of expectations. When analysts set lower expectations for a company, it becomes easier for that company to beat them. So you get headlines about earnings surprises even when the actual performance isn't particularly strong. It's not that the numbers are wrong, it's that the context around them can be misleading. Beating expectations doesn't always mean doing well. Sometimes it just means doing slightly better than a cautious forecast. And in today's environment, those forecasts have become more conservative. Another layer to this is how companies are choosing to invest or not invest. In the past, strong earnings were often reinvested into growth. Companies would expand, hire, build, and innovate. Now, many businesses are taking a more cautious approach. They're holding back on big investments, they're prioritizing stability, they're focusing on protecting margins rather than pushing aggressively for expansion. So even when earnings are strong, they're not necessarily being used to drive future growth. That changes the meaning of those earnings. They become less about momentum and more about control. There's also something happening beneath the surface that doesn't always show up clearly in earnings reports, and that's shifting demand. Consumer behavior in the US has become more unpredictable. People are still spending, but they're more selective. They're trading down in some areas, pulling back in others, and changing how they prioritize purchases. That kind of behavior doesn't always show up immediately in earnings. A company might still report strong results, but at the same time, it could be noticing early signs of softness, slower order growth, more cautious customers, or increased sensitivity to pricing. Those signals don't always make headlines, but they matter because they point to where the business might be heading, not just where it is today. Another important factor is timing. Earnings are backward-looking. They tell you what already happened, not what's about to happen. So a company can report strong earnings based on past performance while simultaneously preparing for a more challenging future. That's why you sometimes hear cautious language during earnings calls, even when the numbers look good. Executives might talk about uncertainty, changing conditions, or the need to stay disciplined. And that's often a clue that the headline numbers don't tell the full story. There's also the growing complexity of business operations. Large companies today operate across multiple regions, markets, and product lines. They use various financial strategies to manage performance, from adjusting spending to optimizing pricing to shifting focus between different segments. All of that can influence earnings, and while it's all part of normal business operations, it also means that earnings can be shaped in ways that don't always reflect simple, straightforward growth. So when you see strong earnings, it's worth asking a deeper question. Strong compared to what? Strong because of real demand, or strong because of internal adjustments? Because those are two very different things. This doesn't mean that companies aren't performing well. Many are. But the way performance is being achieved is changing. We're moving from a period where growth drove earnings to a period where discipline drives earnings. And that shift has big implications. It means that traditional signals might not be as reliable as they used to be. It means that surface-level metrics don't always tell the full story, and it means that understanding a business requires looking beyond the headline numbers. For investors, analysts, and even everyday observers, this creates a new challenge. You can't just look at whether a company beat expectations. You have to understand how it did it. Was it through expansion or contraction? Through demand or pricing? Through investment or restraint? Those distinctions matter more than ever, because in this new environment, strong earnings don't always mean strong momentum. Sometimes they mean the opposite. They can signal that a company is pulling back, tightening control, and preparing for uncertainty, and that's why they're starting to look misleading. Not because the numbers are wrong, but because the story behind them has changed. So the next time you see headlines celebrating strong earnings, it's worth taking a second look. Because what looks like strength on the surface might actually be something much more cautious underneath. And that difference is where the real story is.